If you like what you see, if I can please request you to subscribe to my channel. So what is a private placement? A private placement is a sale of shares or bonds to pre-selected investors. In a private placement, securities are not sold publicly. You can think of a private placement as an alternative to an initial public offering. Banks, financial institutions, mutual funds, insurance companies, pension funds, wealthy individuals are all participants in the private placement market. But what are some advantages and disadvantages of these private placements? Private placements are a quicker process compared to IPOs. IPOs need a lot of disclosure. The light touch, regulatory nature of private placements allows companies to raise funds with lesser time and expense. You do not need a credit rating from a bond agency. It also allows you to sell to accredited investors who understand potential risks and rewards. Borrowers can raise substantial amounts of capital, almost to the tune of $1.5 billion via this route. In private placements, buyers are much more demanding. They do require higher interest rates, fixed dividends, greater ownership, and all of these force a company to perform at a much, much higher level. But when considering debt, how do private placements differ from a bank loan? We can think about this from two standpoints, the first being tenor and the second being stability. When considering tenor, bank loan commitments tend to be much shorter term, 3 to 5 years generally. Private placements, on the other hand, are longer term, 3 to 12 years. The longer term nature of private placements allows businesses much more time and minimizes refinancing risk that comes with shorter term maturities. On the stability side, it allows to have a diversified investor capital structure. You can have banks, but you can also have insurance companies, mutual funds, wealthy individuals in your capital structure. The private placement market is also much more stable. Private placement financing is available even when the overall bank market is closed for business. So what's the final word on private placements? Well, for one, they do allow business owners to raise capital by evading a long, difficult, and cumbersome IPO process. It does allow businesses to raise money from pre-selected investors. But with everything and every aspect of financing, there's almost always two sides to every coin. It does come with demanding investors who seek compensation for taking that extra risk of investing in private placements. So my question for the day is, what is an interest rate swap?